Welcome to the deep dive. We're here to give you that shortcut to understanding the big moves in real estate. And today we are really digging into Essex Property Trust, that's ESS, specifically their Q3 2025 results and their strategy.
Right. And the big headline, the thing that everyone sees first, is that ESS put up strong Q3 numbers. And maybe more importantly, they raised their full-year guidance for 2025. That's the key takeaway for investors, initially anyway.
Okay, but, our job here is to figure out what's really behind that confidence. Was it just like booming operations across the board or something maybe a bit more nuanced?
Exactly. We need to unpack those financials, look at the regional performance of Southern California, Northern California, Seattle, and piece together how their capital moves, buying and selling properties, actually support that guidance boost.
Yeah, because it feels a bit like mixed signals, doesn't it?
It really does. The guidance increase is solid, no doubt.
Yeah.
But once you peel back the layer of asset sales and look closely at leasing, especially that split between new renters and renewals, you see where the market's getting tight.
That's the insight we want to get to.
Definitely. It's something every real estate watcher needs to grasp right now.
All right, let's kick off with those main financial numbers, Q3 2025 versus Q3 2024. Net income per diluted share, wow, up 39.1%, jumped from $1.84 to $2.56. That looks huge.
It does look huge. But remember, with REITs, net income often has a lot of noise. That 39% spike, almost all of it came from non-recurring stuff, specifically big gains on selling properties.
Ah, the asset sales.
Yep. Just two properties they sold, the Grand and Fourth and U, brought in a $62.3 million gain. That's real money, sure, but it's not something they repeat every quarter from just running their apartments.
Okay, so net income is kind of skewed. That's why we always look at core funds from operations, FFO for REITs. That's the better measure of operational health, right? What did core FFO show?
Much more modest growth there. Core FFO per share was up 1.5% year over year, came in at $3.97. Now that's your indicator for how the core business is actually performing.
1.5%. Still positive, and they did beat their own guidance midpoint by 3 cents, you said.
That's right, beat it by $0.03. So operationally, things are okay, maybe a little better than they expected internally.
But only 1.5% growth. I mean, is that cause for concern? Or just inflation eating into things?
Well, it's definitely a bit of both. Inflation is hitting expenses hard. We'll get to that. But it also shows that, rent growth isn't exactly setting the world on fire organically. Still, beating their FFO target, plus having all that cash from asset sales, that gave them the room to raise the full-year outlook.
Okay, let's break down that new guidance.
Right. So full-year net income guidance, the midpoint went up by a hefty $1.41. Again, driven by those property sales. But more critically for operations, the core FFO guidance midpoint was bumped up by $0.03. The new range is $15.89 to $15.99 per share. That implies about 2.2% growth for the full year compared to last year.
And crucially, they kept their same property growth forecast the same, didn't they? Revenue midpoint at 3.15% and NOI at 3.10%.
Exactly. So the message seems to be the core engine is chugging along as expected, steady. But the real juice, the thing letting them raise the overall numbers, is that smart capital recycling. Selling high, planning for the future.
Okay, that makes sense. Let's move into those same property operations then. Segment 2. Overall, you mentioned same property revenue grew 2.7% year over year, and NOI was up 2.4%. Financial occupancy seems pretty stable, right? 96.1%. Just a tiny dip.
Yeah, very stable occupancy. 96.1% is solid, down just slightly from 96.2% last quarter and last year. But within that 2.7% revenue growth, the regions tell different stories.
Let's hear it.
Northern California is, maybe surprisingly to some, still the leader. It had the strongest overall growth at 3.0%. And get this, San Francisco County was up 5.0% year over year. San Mateo County, right next door, up 4.4%.
Wow, SF still pulling strong numbers despite everything we hear about tech and remote work.
Seems like the underlying demand and maybe lack of new supply there are just really powerful forces. But then you look south. Southern California grew 2.4% overall, but it was really varied. Ventura County did well at 3.3%, but San Diego, only 1.4% growth, lagging quite a bit.
Interesting. And Seattle?
Seattle Metro was solid, matched NorCal at 3.0% revenue growth. So good performance there too, on the top line at least.
Okay, now here's the part I think is really key for understanding the market dynamics. The net effective rate growth. The overall blended rate, combining new leases and renewals, was 2.3%, which sounds...
Yeah, it's okay, but it hides the real story. You have to split it out.
Yeah.
New lease net effective rate growth was actually negative, minus 0.5%.
Minus 0.5%, okay.
But Renewal net effective rate growth was strong, positive 4.0%.
Wait, explain that difference for everyone listening. What's
Yeah.
that telling us?
It's telling us the market for attracting new tenants is really competitive right now. When that new lease rate goes negative, it means after you factor in concessions like giving a month or two of free rent, the new person moving in is paying less, effectively, than the person who just moved out.
So they're essentially discounting pretty heavily to fill empty units, buying occupancy.
You got it. They're running promotions, basically. But on the flip side, they have decent pricing power with their existing tenants. People who are already there and renewing their lease are seeing solid 4.0% increases.
So the renewals are propping up the overall average.
Absolutely. That strong renewal rate is kind of papering over the softness in attracting brand new renters right now. And if you look at what drove the overall 2.7% revenue growth, scheduled rent increases made up 2.4%. Vacancy actually hurt growth slightly, pulling it down by 0.2%. So keeping those existing tenants happy and paying more is critical.
Okay, that leasing picture is clear. Let's talk costs now. Did expenses chew up that NOI growth? This is segment 3, operational costs and capital strategy.
Yeah. Costs are still a major headwind. Same property operating expenses jumped 3.5% overall compared to last year. That's hitting everyone, not just Essex.
What were the biggest culprits? Insurance, I bet.
You nailed it. Insurance and a category they call other costs soared 10.1%. Utilities were up 7.8%. And even personnel costs rose 6.5%. Interestingly, maintenance and repairs actually went down a bit, 2.2%.
That 10% jump in insurance. Wow. Every landlord must be feeling that.
For sure. But here's where it gets interesting again with the regions. Remember, Seattle had good revenue growth.
Yeah, 3.0%.
Well, they also managed their costs incredibly well. Seattle metro expenses actually decreased by 0.2% year over year.
Decreased? How?
Good question. The report doesn't detail exactly how, but maybe property tax timing or specific utility management. Whatever the reason, that cost control meant Seattle had the best same property NOI growth by far at 4.4%.
In Southern California?
The opposite story. Expenses there surged 6.2%. That really dragged down their NOI performance.
Huge difference. Speaks to maybe local cost pressures or management focus.
Okay, let's shift to the strategy side, the capital allocation. This seems to be the real engine behind the guidance race.
Totally. It's about asset recycling. In Q3, they bought one property, VO in San Jose, for $100 million. Nice, newer asset in a key NorCal market. But they sold 3 older communities for almost $245 million. They're clearly selling assets they feel are non-core or maybe peaked and redeploying that cash.
And the focus seems laser sharp on Northern California.
Absolutely. The data shows something like 90% of their net buying, that's acquisitions minus dispositions since 2024, has been focused on high-quality spots in Northern California. We're talking over $636 million net investment there.
And they're upgrading the portfolio's age profile significantly too, right?
Massively. The properties they're buying average around 22 years old. The ones they're selling, average age is closer to 38 years.
So that's a 16-year improvement on average. What does that mean practically, though, for you listening? It means lower maintenance costs down the road. Newer buildings need fewer big capital repairs, roofs, HVAC systems. They also tend to attract tenants willing to pay a bit more, and they compete better against brand new construction. So ESS is essentially trading some potentially higher near-term yield from older assets for more stable, lower maintenance, higher quality cash flow in the long run.
Smart. And they're doing other things with capital, too, like preferred equity.
Yeah, keeping the cash working. They got about $71 million back from preferred equity investments in Q3, making a nice 10.1% return on that. And they quickly put $21 million of that into a new preferred equity deal in South San Francisco, targeting an even better 13.5% return. It's a way to generate good returns while they line up the next big property acquisition.
Okay, let's wrap up with the balance sheet and a look ahead. Segment 4. Liquidity seems strong.
Very strong. They had about $1.5 billion in total liquidity at the end of September. That's cash, marketable securities, and what they can draw on their credit lines. It gives them lots of flexibility.
And they've been active managing their debt as well.
Yeah, really proactive there. They increased their main unsecured credit facility to $1.5 billion and pushed the maturity date way out to January 2030. And they locked in a pretty good rate, SOFR plus 0.775%. It's quite favorable.
Good move locking that in.
Definitely. They also extended a $300 million term loan out to 2031. So they're shoring up the balance sheet, extending maturities, managing risk, All good stuff.
All right, final point. Let's connect back to that leasing pressure we talked about, the negative growth on new leases. How does that stack up against the future supply outlook? Where's the competition coming?
So the reports flag Seattle Metro specifically. It's projected to have the highest amount of new multifamily supply hitting the market in 2026 relative to its current size. They estimate it at 1.0% of existing stock. And that's using a methodology that already tries to account for construction delays, so it's probably fairly realistic.
1%. How does that compare to California?
Much lower down south. Southern California overall is only projected to see about 0.4% new supply added in 2026. So significantly less pressure from new buildings there compared to Seattle.
Okay, so let's try to tie this all together for you. The big takeaway on Essex Property Trust. That guidance raise, while positive, isn't really being driven by massive organic rent growth right now. In fact, attracting new tenants requires discounts. Instead, it's fueled by smart, strategic asset recycling, selling older properties for big gains, and reinvesting that cash into newer, better assets, mostly in Northern California.
Right, they're managing costs well in some areas like Seattle, but facing pressure elsewhere. And that underlying weakness in new lease pricing shows the market is competitive.
So the strategy is about upgrading quality and betting on NorCal resilience long-term while navigating current market headwinds.
Exactly. Which leads to, I think, a pretty provocative question looking ahead, maybe to late 2026. We see negative growth on new leases now. We see projections for significant new supply hitting markets like Seattle soon. So the question is, how long can those strong 4% renewal increases keep masking the need for concessions to get new tenants in the door? And what happens to overall NOI growth, especially in markets like Seattle, when that new wave of competition actually arrives? Will the portfolio upgrade be enough protection?
That's definitely something to think about. A great point to end on. Thank you for digging deep with us today.